you're not alone in feeling like everything is changing. The institutions that governed us for the past 70 years are weaker. And in an environment where the institutions are weaker, everybody, including startup founders, has to be paying more attention to their relationships, because that's what gets stronger when institutions are declining. Your character actually matters more because people can't trust, right? Oh, you're coming from this big company. Well, that doesn't mean as much as it used to. Or you're coming from this university that's now under assault by the government, right? The institution is weaker. It doesn't mean as much in this world that we're evolving through at the moment. So I think you have to pay a lot of attention to keeping your word, to doing what you say you're going to do, to the people that you do form a coalition with, right? They do need to be aligned with your values. These are the things we write about in the book, because in this messy middle, those personal qualities do matter more.
Welcome to the Invisible Ink podcast. I'm your host, Shubha Chakravarthy, Chief Financial Storyteller at Achieve. Our guests for today are Elizabeth MacBride and Seth Levine. Elizabeth is a journalist, author, and entrepreneur whose reporting and commentary on finance, innovation, and global economic change have reached millions of readers worldwide. She's the co-author of 3 books, including The New Builders, The Little Book of Robo-Investing, and Capital Evolution, released in December 2025. Seth is a longtime venture capitalist and works with venture funds and companies around the globe. His day job is as a partner at Foundry, a Colorado venture capital firm with nearly $4 billion in assets under management. He co-founded Pledge 1%, a global network of companies that have pledged equity, time, and product back to their local communities. He's the co-author of The New Builders and Capital Evolution. Let's get started. So Seth and Elizabeth, welcome to Invisible Ink today. I'm pretty excited to get started.
Thank you for having us. We're happy to be here.
Yeah, great to be here.
So before we get started, I know both of you come from very different backgrounds. So I'm just going to start us off with, I don't know, Elizabeth, if you want to tell us your one superpower, and then Seth, if you can follow.
That sounds great. It's a fun question. So I am a longtime business and financial journalist. My one great superpower is curiosity. It's led me into many places all over the world, and I'm never afraid to ask a question.
Fantastic. So you're going to be on the other side of that now. And Seth, what would you say is your superpower?
I'm going to be curious to see whether Elizabeth agrees with this. We know each other quite well. So I'm a longtime venture capitalist. I've been in the venture industry for 25 years. I started my own firm about almost 20 years ago now. And Elizabeth has known me for a long time because we've written now 2 books together and we spent a lot of time together. I think my superpower is I tend to sort of advocate for my ideas very strongly. And then like in a second, I'll find, if I like really get pushed, I'll be like, okay, you're right. And I'll be done. And so I think I can change my mind even when or be convinced to change my mind, even when because I'm a pretty stubborn guy, even when I have been holding on to something, I think I can do that pretty quickly.
Fabulous. Well, it's going to be a fantastic conversation.
It's probably infuriating, by the way, to people on the other side of it, because they're just like, why are you still arguing? And then 2 seconds later, I'm like, yeah, you're right.
No, it's great. It's great because then I can feel like I win.
There's a positive to everything.
Exactly. You win all the time.
Oh, not true. That is completely.
I knew that would get her going.
So congratulations on the release of your book, Dynamic Capitalism. I had to read through it and it's pretty phenomenal. So just what's the short summary? What's the core thesis of the book and why did you feel the need to write it now? Like, what are you hoping to accomplish with the book?
Well, first, let me say it's Capital Evolution is the name, but it is about dynamic capitalism. The thesis of the book is that we're in the midst of one of the periodic transitions that overtakes capitalism, especially American capitalism. What some people have been seeing as the end of capitalism or the collapse of capitalism is actually just a periodic transition. And we decided to write the book because 3 years ago when we started it, we were both seeing signs of this shift underway, but we had not yet identified what was happening. So we saw signs that things were changing, and we wanted to figure that out for ourselves.
Awesome. Capitalism is at the heart of startups and getting startups funded. And one of the arguments you make is that capitalism isn't collapsing, but is evolving, as you just mentioned. So if you're a founder, particularly, in the thick of the battle for getting capital, What do you think are the clear signals that founders are seeing today or should expect to be seeing that this evolution is happening and maybe it's a revolution? I don't know. You'll convince me about it. What are those signs?
Yeah, well, I think it's to be seen whether it's an evolution or a revolution. Let's hope it's an evolution, because revolutions tend to be messy and sometimes dangerous. So we don't necessarily want that. But I think specific to startups, I actually don't think there's this thing that is specific to startups as we think about sort of the overall transformation of our economy. I think it is true of startups and true of, and I'm saying tech startups here, right? Because of course, most startups, most brand new businesses aren't technology businesses. They're called a Main Street or mainstream
Exactly.
business,
Yep.
which is really important, right? And that was the subject of our last book together, actually, The New Builders. But interestingly, and this is often the case, which is in part why our innovation economy works so well, as is the case often, there's ideas that are bubbling up from the innovation economy, the startup economy, right? So one of the things we talk about a lot in the book is not just sort of the concentration of wealth, assets, power, et cetera, but also the concentration of ownership, right? Very few people actually own the majority of public stocks, for example. Obviously, if you own private assets, the government at the moment says that you need to be an accredited investor for the most part, which means you need to already be pretty wealthy. And so all of this has resulted in this sort of like overall concentration of assets. One of the things that startups have done really well is actually be more thoughtful about employee ownership, right? More thoughtful about leading with values, more thoughtful about other ways that they are affecting their communities, suppliers, et cetera. And these are all aspects that we talk about of dynamic capitalism, which is what we name the sort of next version of capitalism, in contrast with neoliberal capitalism, or what you might call Friedman-style capitalism, which is governed for the last 50 or so years. That there actually are these other aspects to operating a business, especially if you take a long-term view, that are important. And so I think there's actually quite a bit that big businesses can learn from smaller businesses and startup businesses.
That's a great point that you make there. So it's clearly, in terms of the output that's going out from the startup, I think the point you made is you're seeing more of the employee ownership, the stock option plans and all that stuff. From an incoming side, in terms of where the capital is coming in, are there things that are either happening right now or that founders should expect to see happening in the next 3 to 5 years as they plan their build out of their firms?
Yeah, maybe I can take one pass at that and Seth can add to it because I feel like he's got a closer lens view on that question. Well, first of all, I think the clearest sign to me that something major was afoot was actually at the top of the economy. And we wrote about it in the first chapter, which was that the Business Roundtable had adopted essentially a new definition of capitalism. It got sort of a bubble of attention, but then it was lost in the political divisiveness that rules our current reality. But
COVID, by the way, hit 4 months later too. That didn't help.
Right. And COVID did 4 months later. Yes, absolutely. They adopted it 5 years ago. They're still operating under this new definition of capitalism. And those CEOs of those giant companies do have a lot of control over the world. So that's the clearest sign that things are shifting. And I think in terms of the capital and founders and startup founders in particular, raising capital, what I've said, I don't know if you'll agree with me on this, Seth, because we've been asked this question in the past week or so. What I'd be paying attention to is having to change your messaging. I feel like the old rules of capitalism were just money, right? Business model. This is how you make money. This is your large market. This is what you're aiming at. This is the big idea. And then having a track record or a team that could show you could, fulfill that vision. And now I believe investors are going to be taking that question of values more seriously because it will and is already becoming a differentiator because consumers have the power to pick the companies that are winners and investors also. There are an increasing number of investors who actually do care about what your values are and whether you're meeting this current moment, which is shifting toward a values-driven economy.
I love that. So Seth, I have a question for you on that, right? So you're like right at the center of the action. You're a venture capitalist. And I know from having talked to you that you do care about values, but you're also an observer in the larger VC system, right? So do you actually see this happening outside of like the pockets of impact-oriented, investments, just in the what I'll call the mainstream startup investment community?
So one of the things I think we should clarify is what we are not suggesting in dynamic capitalism is that every company should be an activist company, right? Like that doesn't work. And in fact, we very clearly say we don't think that that's what should happen. And in part, what led us to write the book was some questions around where that line is and should companies take stances on certain issues, right? And I think we spent a lot of time both debating, Elizabeth and myself debating, but also with some of the people we interviewed, in particular with Jamie Dimon, who's the CEO of JP Morgan Chase. He was also the chair of the Business Roundtable when they came out with that new proclamation on the role of businesses in society. And we pushed him a lot on this because he was sort of arguing for a values-driven orientation, not a politics-driven orientation. And we really pushed him for, well, where's the line? Because don't politics stem from values? And maybe that's getting blurrier now because there's a set of values around affordability and things like that. But I want to clarify that because I think it's important because oftentimes when you hear about the future of capitalism, and it was certainly, we read a bunch of other books on this subject sort of in preparation for writing this. And one of our critiques was that the vast majority fell into two categories. One was sort of an academic treatise, right? Usually written by someone at a business school or a university, pretty unpractical, right? Written by people that didn't have a lot of direct experience in business. And then the other was sort of a personal journey story, right? A CEO of some company that whatever had been successful and they had some values orientation. They want to share that with the rest of us. Interesting, but not necessarily extensible to other companies. And Elizabeth and I really felt like we bring kind of a different perspective, right? As practitioners, people who've been in business for 30 years, writing about business, observing business, investing, in my case, in businesses, working for businesses, et cetera, that was a different orientation. And so the book is very pragmatic. And I want to be careful as we sort of set up the kind of the broad arc of what we're talking about, that this is not some pie in the sky. What if we just, all held hands and got along, that somehow would be better, right? Like, we are both capitalists. The book is a defense of capitalism, not of the capitalism we've been practicing necessarily, but a recognition that capitalism is still, like, sort of in the Winston Churchill way of saying it, right? It's maybe not, it certainly isn't perfect, but it's the best of the others, everything else we've got. And it feels even more important to be having this conversation now because as we're recording this, New York just elected a socialist mayor, right? But at the same time, there's 11 companies worth more than $1 trillion. NVIDIA recently, it's backed off in the last few days, but was worth more than $5 trillion. It's bigger than the entire economy of Germany, right? So these things are happening at the same time, right? Elon Musk has a potential $1 trillion pay package. So these things are all happening at the same time. And to us, they are signs that we need to have a real discussion about what's going on in our economy and how people participate in our economy, right? We often say that populism on the right and the left are driven by the same thing. People feeling like they were unconnected from the market system. Their ideas for what we should do are wildly different. And, you can read the book and kind of figure out, we don't talk about, Mamdani showed up after we wrote the book, but you can imagine what we'd say about that. But it is important to understand, where does this come from, right? And then, of course, how can we do better? And we have some thoughts on that.
Awesome. So in terms of, I just want to kind of close out the conversation on values, right? People have a certain association perhaps on values. Can you give us some good examples from either real life or some of the companies you've seen of what might be not traditionally thought of as a value, but still operates as a good value to guide a startup or any kind of new venture, growing venture?
Yeah, so there's a lot of examples in the book and some research as well available from a group called Just Capital, which actually surveyed the tons of people across America and came up with what people really want in terms of a value from their company is, first of all, that they treat their employees well, which, right, that's not, you don't hear people talking about that so much in the impact space, right? Which is a sign that maybe the impact space is also needs to evolve. But in treating your employees well, it was the number one value that Americans want companies to do. And let's face it, right? Companies have a long way to go on that journey. There are many companies that do not pay their people well or do not treat them well in terms of labor conditions. So that's one. And we also gave examples of a lot of other companies. One traditional sort of impact darling would be Patagonia, right? So environmentalism broadly, that's a value that a company can build itself around. We also give the example of Hobby Lobby, which really built its value system around the idea of the faith of its founders. And that has led them and attracted a loyal client base and also probably employees who largely agree with that set of values. So we're not saying, as Seth said, it's not like holding hands and Pollyanna and kumbaya. It's more like in this environment, a startup founder really needs to know who they are, what they stand for. And I would say from the beginning, they need to know that in this environment, because it's going to help determine who your customers are, who your investors are. It's going to narrow down the work you need to do to find the funding.
One of the things this makes me think about, Shubha, if I could just interject, is the first question I ask every company that pitches me for investment in my day job as a venture capitalist is to give me their backstory. Tell me how you arrived at this idea. And it's not explicitly a values question. And Foundry is not a values-oriented investment firm in the sense that our investors simply want us to return more money than they gave us, right? Like we are only measured on that. We are not measured on any other sort of impact measurements. And so they somewhere between tolerate and embrace that we, for example, became a B certified financial services firm. We were one of the first certainly the first really large venture fund to do that, followed by Techstars and a few others. But that can't come in the way ultimately of our making more money. Now, we argue back to them that having this values orientation allows us to both win more deals, but also find founders that sort of are more likely to be successful, which is why, back to the question that I asked, why I ask every company that comes to pitch me that question, because I'm searching for that thing that drives them, right? And when things are hard and not working, what is it that's going to get them, popping out of bed in the morning, ready to go knock down walls again, even if yesterday they ran into a bunch of walls and it seemed futile. There's a values concept behind that, right? That I think is really important. Sometimes it's explicit around other things, right? I mean, there are venture-backed companies, Warby Parker comes to mind, or Etsy or others that are like very clearly, hey, we are giving a pair of glasses away for everyone we sell, or we are trying to empower this group. And we think that that's also a good business idea. And then there are others that are much more subtle, which are like, hey, we come from a marketing background and I can't believe this thing doesn't exist. Why can't you do this and this with your data from this system and this system? And we've got to fix that. And there's a sort of a funny values orientation inside of that as well.
That's interesting. Never thought about marketing, data, and values in the same sentence, but now I will, right? So the thing that becomes very clear to me is a couple of things, right? There's a macro level conventional understanding that you can, pick from this. But to me, the more interesting thing is, Seth, what you mentioned, which is it is a differentiator. It is a driver, a motor, an accelerator for progress, which also sets up very clearly who they'll attract and who they will not attract. So in that sense, it's a differentiator, right? Like it's clearly a motivator and a differentiator. I hadn't thought of it that way. And that's super interesting. Thanks for that. You talked earlier about capital concentration, right? It's very clear that capital is getting more and more concentrated. It's consolidating right at the top. And yet, if we are to say America has always been known as an innovation economy, we've been at the forefront of innovation. And at the heart of innovation is experimentation. And the core of experimentation is error and failure. So how does that show up? And what are the practical implications for founders when they're pursuing this capital that's highly consolidated, and yet they have to face, to your point, said, run into walls every single day in the process of experimenting? Like what's that tension, and how's that showing up in impact on innovation?
Oh, it's so serious. I think you have to understand this from the macro level, because Seth and I think, are both very concerned about the way the innovation economy broadly is evolving as we're in this kind of like transitional moment, because there are troubling signs that the innovation economy in the US is heading for a downturn, right? Because of the concentration of capital, because the federal government has pulled back on some of the research funding, because it was, as you know well, like a huge funder of deep science and deep tech, and that's what really drives the big innovations. And then at the same time, you've got other countries, China, that are experimenting with developing their own systems of innovation. We're both like Jamie Dimon, right? Red-blooded American patriots, I think. Part of our motivation for writing the book and speaking out so much about it is that we do believe that America still has the edge on innovation, but we need to recognize that it could be slipping.
Seth, what's the answer? Or
Well, more broad, we just want to frame it for a second for listeners, because more broadly in the economy, what we would call economic dynamism, right? Which is a dynamic economy that's resilient and where people have opportunity to both move jobs, move locations, but also move up their station in life. Like, that has been decreasing significantly in the United States, right? Which is why, Elizabeth and I, along with Congressman Ro Khanna, wrote an op-ed in the LA Times about sort of investing in our innovation economy. It's why we care so much about this topic. We can't take it for granted. And I think part of our argument in the book is we don't take this for granted. Like, we actually need to do things to maintain that economic edge. The US continues to be the place where people want to come to start their businesses. We have a society, generally speaking, that's very open to that. We're open to failure, right? Which is a big differentiator between us and many other countries. And we continue to have the best sort of innovation funding ecosystem despite all of its flaws. And so, I'd like to see us, of course, get better about that, fund more and diverse types of founders who have different ideas, right? There's lots of research that suggests that there are many great ideas out there, right? What do they say? Opportunity is not evenly distributed, but talent is. And so we should do a better job in our innovation economy of finding those incredible innovators that maybe don't come directly from our networks. That's probably a topic for an entire podcast, something I've thought about a lot. I think I've mostly failed at, frankly, although I've tried to work in and around for basically since I've been in venture. But these are all things that I think are important for us to lean into as we think about how do we maintain our competitive and economic edge. And that's what we're arguing for in the book, right? We believe that the US should continue to be the country that leads the world in economic innovation. There is a reason that the biggest companies in the world biggest technology companies for sure, are all from the United States, right? The Mag 7 is a distinctly American phenomenon, but we can't take it for granted. We have to fight to keep it. And that's what the book is really about. Some practical ideas and maybe some unpractical ideas for how we make sure we maintain that.
Got it. So is there like one takeaway in terms of a founder who needs to indulge in or engage in that experimentation, but faces, let's call it consensus capital, right? And still has this wall. Do you have like one takeaway that they could use tomorrow, Monday?
I'd be careful. I'd be very interested in which state and geography within the United States to locate my very innovative startup. That's my takeaway in the current moment. I don't know what you think about that.
Well, I'd also say that too many people are trying to play exactly the game as it's defined right now, and the rules are skewed, right? And so I think one of the solutions is to not play the game that way. And there's a bunch of ways to do that. One is to stand up your business and go find customers first, right? Another is some different forms of capital. I think this is kind of what's behind Elizabeth's comment about like what state you start in matters. Like, there is a lot of both place-based capital out there, but there's also quite a bit of state level fund, things like that, where you can actually, get paid to go move your business somewhere. I mean, that may be a dissatisfying answer because we also need to work to change the rules of the game, right? So people have better access. And I experienced this myself. I'm a startup founder as well. And I've gone through the process of trying to get sort of people to respond. And it's infuriating, but you also have to stay at it, right? And the number of companies that Foundry, for example, is funded where, we were the 37th or 370th, right, firm that someone reached out to, but it ended up being incredibly successful, right? Like, sometimes you just have to keep going at it. And I think that there's some truth in that, right? And I think one of the things that's maybe frustrating about sort of the Silicon Valley culture is that there are some companies that it's so easy and you kind of fit the archetype and, people are lining up to give you checks and it's incredibly frustrating. There are a lot of people in the world right now who are trying to fix that and who are interested in talking to founders that don't look like that, but they're not high profile, flashy, they tend to be somewhat smaller, somewhat newer funds. And so it takes a little bit more work to find them.
So I'm all ears on both of those. So Seth, tell me, where can I find them? Who are these people?
Well, you could. Foundry has funded a lot of them, right? So we have a funds portfolio as well as a direct venture portfolio. So you could start there, right? If you just go look at the funds on our website. But that's 50 funds, right? There's 500 of these funds, and so it's going to take some research, right? But you've got AI tools now to help you do that, and you've got more traditional search tools. But if you're looking for a place to start, you can start on our website. But I would expand that, right? There literally are hundreds of firms that have been stood up in the last 3 to 5 years that are really trying to actively change the paradigm. And so it just takes a little bit of effort to find them.
Fabulous. And Elizabeth, any additional light on the state comment? That is very intriguing.
Well, I do think there's place-based capital, but I think, I mean, my observation from reporting all over the US is that there are some places that, first of all, are more supportive of deep tech and more deeply innovative companies, right? They tend to be around universities. I think capital clusters in those places that is there to build those kinds of companies. Like geography is something that founders, especially those who come from the two coasts, don't recognize as a big driver. There's a lot of capital in the world that's predicated on the idea of we want the next big thing to be from our city, right? And so High Alpha in Indianapolis is a good example of that, right? It was a big company acquired by Salesforce that really
Scott, it was Scott Dorsey's exact target.
Yeah, exact
You'll
target.
find them on our portfolio page.
All right.
Yeah. And they're like the wall, like Bentonville, Arkansas is another place like that. Minneapolis, there will end up being a big successful company that is acquired or goes public from a second tier market. And then out of that, one of the founders will become themselves the center of a new venture ecosystem, and they'll start funding startups.
That's fabulous. Those are two very good actionable items. So thanks for that. One other thing is, you're starting to see with this consolidation of capital, it's just all these huge asset managers like BlackRock and others. And definitely it has a downhill effect, right? They're controlling capital right at the top. They're the ones who are determining asset allocation into various classes, including venture capital and all of this stuff. How is that going to impact startups' access to capital? And in particular, I'm going to ask you about this latest thing I'm seeing on LinkedIn in terms of, consensus capital and non-consensus capital, and how there's been this stratification or this barbell effect, or you're seeing the consensus firms at the top just, investing in a certain class of startups and then leaving a whole bunch of other startups out in the cold. I'm just curious about what your thoughts are on that and what the actionable implications are for founders.
Yeah. I think that the venture capital world, and I've been in venture for 25 years, it expands and contracts and expands. It's just like constantly, that's what happens. And it seems very prone to bubble-like behavior, which I've now decided is probably a feature, not a bug, of how we fund startups and how sort of venture works. And so we are going to experience a contraction. The expansions happen quickly and the contractions happen slowly in the venture market. It's just how it is, right? It takes a long time. It's very, when there's money all over the place, like during ZERP in 2021, it was easier for people to start their firms. And so there was all this money rushing into the sector. And then it takes forever for those firms, if they're not going to be successful and not raise more funds, they're just sort of still out there forever, kind of hanging on. And so that's just part of how it works. So I think we should just recognize that. I don't think actually that the big asset managers, BlackRock and others, are controlling the speed at which either the expansion or the contraction happens. Now, there's a separate issue, let's put a pin in that, about the consolidation of particularly public market resources with the 4 big asset managers. 80% of all investments in public markets are through one of 4 entities. So they have a ton of control. They own a meaningful portion of every company in the world, or every company in the US that's listed. And so that's a separate thing. But specific to venture, this trend that you're talking about is actually something I wrote about years ago, which is the barbelling of venture, where you have these really big firms that are essentially asset managers, right? They're clipping a coupon, which is the management fee. They have massive, massive funds. They've got tons of partners. They have all these services, and they have to make relatively large bets, because when you're investing out of a big fund, that's kind of what you do. But you have a really, really big fund. If you make 2.5 times that fund, there's a ton of carry. There's, if you can do it fast enough, the IRR is good. So that's one type of firm. And then on the other one, you described them as non-consensus, but you have sort of more of the kind of alpha seeking firms as opposed to beta plus, let's say, seeking firms.
I love that.
Which tend to be smaller, right? So they tend to be, in the current market environment, they tend to be call it $150 million or smaller. And those are sort of much more craft firms that are trying to not craft ventures, craft firms that are trying to sort of continue with this style of venture that used to be what everything in venture was. And there's not one that's right or wrong, but it's just important to note kind of the difference. And if you're in the middle, it can be a little bit challenging, right? I mean, I think Foundry sort of bumping up on the upper edge of this bottom thing. You have to kind of strip out our fund of funds practice and sort of we're more in that kind of smaller range, but a couple $100 million dedicated to that per fund. But much bigger than that, you're sort of in no man's land, right? But it's important to recognize that that's really it's been happening for a while, and it continues to happen.
So, Elizabeth, do you have anything to add? And then I'd love to ask you about the practical implications.
Yeah, so I do think there is one thing we haven't talked about, and Seth and I haven't talked about it actually. There's another kind of concentration of capital going on, which is that because of the way the wealth is skewing in the US to individual families, there's also, I think, family offices that do to some extent as limited partners in all kinds of different funds, venture capital funds or private equity funds or different, whatever roles they play. And honestly, like to get any good reporting on how that system is evolving is very different, very challenging to do as a journalist. So we don't really know what's happening in that world. But I do think that they are setting some of the agenda in terms of the innovation that's happening. And so that I think it's just something to be aware of. And I would love for somebody to take that up as an issue and to try and get more accountability into that system of family offices.
Love that. So one last thing on that, and I want to talk about energy transition. So any last words on like where the next generation of genuinely experimental, patient, long horizon capital can come from, especially as you're seeing more and more safe bets in the VC world, if I can be provocative, right? So who's going to fund the truly risky stuff?
Yeah.
Saudi Arabia?
I mean,
maybe.
I mean, it is interesting. If you look at, for example, the announcements in quantum coming out of the Middle East, Qatar just put a bunch of money into joint venture with Quantinium. And, it is interesting to see where risk capital is shifting. And so, yeah, no, I think that's absolutely true. Israel, Saudi, UAE, Qatar, like they are making increasingly risky bets. And I think, if I was advising, the US government and talking about like, why is this important? I would just point to that and say, is that where we want all of this money to go to? Right. And I think one of the things that I actually give Trump some credit for is that 5-6 years ago, AI was not happening in the US. There was such an anti-AI and frankly, anti-crypto sentiment. And I think it was absolutely to our detriment. And I'm glad to see those policies reversed. There's a lot of nuance to what needs to go around that. It's probably more than we want to get into. But broad brushstrokes, is it better to have Tether, which is a USD stablecoin, is it better to have them operating in the open, wanting to be registered in the US? Again, skipping some of the nuances of the agreement that was made with them, 100% it is better. Right? We do not want companies like that operating in the shadows of the world and of the internet. And so I think that we need to be open to and embracing new technology, even if it's scary, if in the case of AI, and maybe scary to some in the case of quantum. But those companies or those technologies will get funded, right? They will progress, and they will progress elsewhere if we don't let them progress here. Yes. So that's my overarching view. Again, there's a much more nuanced view of like, okay, what does that exactly look at? Like, how do we do that in a way that is respectful of privacy? And there's all sorts of things around that. Although actually, I kind of think the market is in the process of helping figure that stuff out. And I think we're sort of in that messy beginning when new technologies show up and we don't really know what to do with them. And we're all, we've got people walking with flags in front of automobiles in 1910 because they're so scary. And oh my gosh, there are these cars. And so there has to be someone. There's got to be a flagger, right? So like we're in that phase right now of some of these new technologies, and we'll get past that and we'll figure out sort of what the right rules are.
And if you were the advisor to one of these startups, what would you say? You said if you were the advisor to the government, but I'm asking you if you're an advisor to a startup.
Well, I'd go to wherever the money is, right? Like if, as a startup, like you want to get going in the place where there's money and there's the fewest unreasonable restrictions. So let's at least put that caveat on it. And so I would be encouraging companies to build where that exists. I believe that that's mostly still in the US, but I have some concerns that it won't continue to be that way. If the rhetoric ends up winning out, if fear wins out, I think that actually what'll happen is it will be incredibly disruptive to the US economy and we won't reap any of the benefits from it. And I think that's a terrible combination.
Thank you. Elizabeth, you're going to say?
I was just going to add to this because I think there are a lot of founders in these deep tech spaces, cryptocurrency, cybersecurity, quantum, that need to be. I'm speaking more from the public responsibility and the idea of evolving jointly our system of economics and society, which is what we write about in Capital Evolution. If you're one of those founders, I think you need to be participating in this conversation because you're innovating in your space, you're seeking money, you're doing all the things that Seth just described. But these spaces are so powerful and they are so important to national security and to the future of our country and economy. You're not just building an e-commerce site anymore like we were 20 years ago. For instance, you take the biggest heist in global history happened in February on a cryptocurrency platform that had no home. It was based nowhere, so it had no regulations. I forget how much it was, $1.5 billion, $2.5 billion in cryptocurrency stolen off that platform by North Korea, by hackers aligned with North Korea. And what did they do with that money? Now they're laundering it through the system because the US had not yet acted to pass regulation to make the stuff secure and transparent. And so North Korea slipped in there, and the national security people I talked to believe that now North Korea is going to launder that money and use it to buy a new missile, right? So these issues are not just in your small startup space, right? They're very serious. And I do think you should put some time and conscience into where you're locating your business and evolving a system that has rules that can work.
Before we dive back into our conversation, I want to tell you about Seed to Success. Seed to Success is our community letter with our proprietary insights on startup financial storytelling, tips, new episodes, and much more. If you find these discussions helpful in your entrepreneurial journey, use the link in the description to subscribe to Seed to Success today and get all of these and much more straight to your inbox every week. Now, back to our conversation. This is awesome. This is good stuff, but serious stuff. There's one other sector in deep tech that we haven't talked about, which is energy and climate, right? So there was a lot of activity, and there still is in terms of the startup space. And one thing I noticed in your book was that you talk about it as a capital allocation challenge, right? Versus maybe some other frames that have been given to it. And clearly the environment has shifted pretty dramatically, I would say, in the last 12 to 24 months in terms of where there was funding, where there was opportunity versus where it is today. So what's the outlook, what's the prognosis, and what's the counsel for founders who are operating capital-intensive startups in this space?
Yeah, I think you had really good questions on this. And it is one of the places where there's a sharp difference, right, between kind of the government's current rhetoric and the realities of the market. And Larry Fink is the best example in our book about this, right? He went out hard 5 years ago saying, we're going to invest in technologies that, protect the environment because this is where we're going, right? We got to move away from fossil fuels. We need more energy. And then he got totally slammed for it, right? Woke capitalism, ESG is a dirty word. And he retreated from it publicly. But when I asked him about it at the Aspen Ideas Festival, he made it clear they're still doing the investing. He's just not talking about it as much. And there's not as much government support for it. So it's an example, just to your questions, of where the reality is not as aligned as it used to be with the rhetoric coming out of the government. But in terms of how you practically play that bifurcated reality as a founder, that I don't know. Maybe Seth, you have some thoughts about that.
Well, I do, but I want to frame it in the sort of the larger context, because I think one of the things that we talk about in the book, which is really important to understand, is the US won the 20th century economy because we were the best and most efficient energy producer in the world. Right now, in the case of the 20th century, those were mostly extractive forms of energy, but it's absolutely true. This is what won the century for us. And we believe that what will win the 21st century will also be energy, right? And we're seeing an example of it, which is sort of like AI and how much power that's requiring. And we are not doing what we need to do as a country to win this next century in terms of energy. And so our belief is certainly to lean into alternative forms of energy, because at a practical level, fossil fuels are going to run out, right? And it's becoming increasingly challenging in many cases to extract them from the ground. But we also argue for sort of a pragmatic shift, this idea that we can like stop pulling, fossil fuels out of the ground, in 2030 or something like that, and just shift completely to alternative forms of energy is just not at all realistic, right? And so we need to be doing both as we transition to a new energy economy. And there can and should be a lot of opportunities in the new energy economy. That's not just how do we build more efficient power plants, although it could also be how do we invest more in nuclear. China has 35 nuclear power plants that are in production right now. We have, I think, 0 or 1, right? So and that might even count the 3 Mile Island thing that they've renamed. I can't remember the name.
I know. I thought that was so funny that I was like, is that 3 Mile Island?
Yeah, no, it's something like Clovis Clean or something. It's some funny name. But and that's, I'm not saying we shouldn't count that in the sense that like, yes, that is true, but like that's relatively old technology that's being spun back up. That's like Gen 1 nuclear technology. We're on Gen 4 right now. And so, which is, by the way, super safe. And just to pick on one thing, but there's also thoughts around distributed energy production, thoughts around battery and how we do battery backup, both for individuals as well as for industrial use. And, we would be spending more time, energy, and money in that, from my perspective, as a country, both publicly and privately, if we were being more thoughtful and smarter about how to win the next century's energy war. And by the way, that'll also include streamlining permitting so you can get these things built faster. And, the amount of power that's required at an AI data center is absolutely massive, right? And so, we are going to struggle to keep up if we can't lessen the burden on exploring new power sources and building new power capacity.
So if I had to paraphrase what you just said, Seth, is it accurate to say that there are 2 main takeaways I picked up from that? Number one is, don't look at climate or energy as a monolith in terms of a market or investment area. There's clearly those subsectors, and you have to be thoughtful about which subsector you're going after and how urgent or compelling that market is, so that you make that choice thoughtfully to the extent that you can. Clearly you're specializing in a certain technology. And the second big takeaway for me was follow the money, right? Where the money is where there's demand. And you can choose to satisfy that demand in a more energy intelligent manner using some of these technologies, so that you're kind of once again helping the US and frankly helping these companies do their job in a more energy efficient manner. Would that be a fair characterization of what you just said?
Yeah, I think that's exactly right. I think we tend to think of energy and energy policy as this like one overarching thing, but it's actually a lot of both little and big things, but a lot of things, right? And I think that's the right way to think about it, both from an investment perspective and from a sort of public policy perspective. And I think, again, just to reiterate, like Elizabeth and I in the book are really pragmatic about this idea that, climate is a real challenge, right? To the story around Larry Fink. And as he said very famously, climate risk is investment risk. So we believe that. We know the government believes that, right? One of the sort of biggest planners, if you will, around climate change is the U.S. Navy. They spend a lot of time, energy, and money trying to figure that out, because, of course, so much of their asset base is sitting in low-lying areas because it's literally on the ocean. But they have the bases and all the things that are surrounding that, right? So that stuff is happening, and it's okay to talk about it. And I sort of want to get away from the debates about, how much are we or humans contributing or whatever. I was on another podcast and he really wanted to engage me in that debate. And I was like, look, it doesn't matter. Like we still need more power, and we're not going to get it by burning dead dinosaurs, right? We're going to have to find other forms of power. So let's talk about how we do that in as efficient and effective a manner as we can, and at scale.
Yeah, and I would just add to this that this is an area where the government rhetoric is so aligned with the fossil fuel companies because they have a big stranglehold on our public conversation, right? You cannot look at the past 100, 150 years of American history and not realize how entwined fossil fuels are in our economy and our public spheres. And some of this divisiveness that we're seeing now is a result of the rest of the world recognizing we need to pull away. We need to find a new path beyond fossil fuels. It doesn't have to be sharp. It doesn't have to be sudden. Like, it's a transition. We're going to work on it together. But to think that we can continue on the path we're on is crazy. The rhetoric coming out of the government, and that is not a political issue, right? Kamala Harris and Donald Trump were the same on the stage about that question, right? Drill, baby, drill, and we need fossil fuels. They both said versions of the same thing. This is a space where the government is not going to have the answer. The market has to create the answer, and the markets are clearly moving toward different forms of energy.
So that brings up an interesting question, right? Like, on the one hand, you mentioned fossil fuels, and both personally from my experience as well as from your book, we know that many of these large companies are seeding alternate fuel or future energy technologies, for pragmatic reasons, number one. And then number two, to your point, there is potentially a dichotomy, or at least a bifurcation between what the policy and the current funding flows are into the space versus what's perhaps happening in the private sphere and what industry is buying, to your point about AI energy centers. I'm trying to come back to the founder who is in this space and who's dealing with this reality day to day. What are the opportunities that they perhaps might not be looking at, and what are some smart, pragmatic actions they can take to increase their chances of getting capital and being successful?
Well, look at European funders, for one thing, right? And I feel like there are a bunch of them who are actually looking for opportunities in the US, because I was talking to some energy think tank guys and some deep tech funders from Europe. And I think that they're looking for startups to fund in the US in this space.
I'll get the list from you after the podcast, Seth.
There you go. I mean, look, we don't fund energy. So I'm a little bit sort of out. I'm an observer, not a participant in these sorts of markets. And so, I continue to believe that there are, and I've seen this directly, really interesting, innovative technology upgrades coming from Cal, Stanford, MIT, other places, right? I hope investors are open to leaning into those things. And there's a huge buyer universe right now, because more so than GPUs, the limit at the moment to increasing data center capacity in and around AI in particular is power, right? So there are built-in buyers for these things. And so there's built-in partners if you have new energy ideas, new ways of extracting, new ways of being more efficient with energy and energy consumption. And by the way, 30% of the cost of the energy portion of any data center is just planning for essentially peak load, meaning peak load outside of the data center, right? So you got to overbuild by 30%. And so, there are, just pointing that out as an example of a place where if you could help address those issues or better plan for those, or, otherwise sort of participate in, that would be an example of, you don't even necessarily need to be the one producing the energy, but if you come up with a new data controller that allows you to smooth those things out, as an example, that would be hugely beneficial, right? Because the cost of a data center for AI is $1 billion+ maybe billions of dollars. The power portion of that is maybe a couple $100 million of it, but it's still pretty big, right? So there are definitely interesting and innovative funding avenues out there for companies if they look for the right partners.
So in my simplistic mind, or simple mind, I'll call that Follow the Money 2.0, which is the advanced graduate level course, if you will. Which I want to come back to one thing you said. You mentioned these universities and the fact that there's all this research happening. But I mean, let's face it, a lot of the research was funded by the government, was funded by the government. And that, I don't think anybody can say with certainty that that's going to continue to be the case in the future. So what does it mean in terms of other options for sourcing innovation, for lack of a better word, for those of our founders who are hungry to tap into these technologies, but can no longer perhaps access some of these grants? Some are still available, many are not. What are your thoughts on that?
It's a tough question, but it's one I think the whole world is going to have to grapple with, because it's not just the U.S. government that's shifting and pulling back from some of these investments. Governments in general are low on money at the moment, right? And probably for the next few decades for a host of reasons. we're going to have to see big philanthropy stepping in bigger ways. And you have already seen the Gates Foundation do that in the health space, more on the ground, like funding current programs, not so much in research. But it kind of goes to the point that I brought up earlier about these huge concentrations of wealth in families. And they have historically founded big foundations that lasted for generations. And I wonder if I were sitting in a room with some of those people, I would say, okay, maybe that's not the best approach right now, right? Maybe this is the moment to say, I've got this big pool of money and I'm going to spend it over the next 20 years on this particular innovation. Maybe that's one source, potentially.
Interesting. Seth, did you have any other thoughts?
I think those are all great ideas, right? As government continues to step back. Now, I hope that there's a ebb and flow to that. And I hope that at some point we'll recognize that that's probably not in the interests of the U.S. And, we do have a sort of economic and potentially military adversary in China that is investing very heavily with state money in sort of foundational research. And that has done very well for the U.S. In its history. And sort of we abandon that at our peril. But I do think that there are other sources of that. And I'd also say that there are really large companies. I mean, one of the benefits, I suppose, of the incredible profitability profile of many of our largest businesses in the US is that they have room to experiment with a bunch of different things, right? I mean, think about just Microsoft's investment in OpenAI, $1 billion in 2019, back before any of us understood what that was. And, had any ever even heard of ChatGPT, right? I mean, that helped them kind of get off the ground. Obviously, Google has all sorts of projects going, from Waymo itself driving, which was sort of this skunkworks idea, to flying taxis, to all sorts of other things. Many, we probably don't even hear about a ton of them that just end up not working out. And it's no accident that there's a lot of quantum research being done at Google, right, in their Willow project, and IBM and sort of other large companies. So, do I think it's the best thing for the U.S. innovation economy to only have kind of science-based research being done, 10, 20-year life cycle research being done at companies? Probably not, but I'm glad that at least some of that's happening. And hopefully, to Elizabeth's point, some foundations, family offices, et cetera, will step in.
So the practical implication then for somebody who wants to, pursue an idea in this area is to maybe work for one of those companies. I can certainly see that. But we're still talking about the traditional path, which is, hey, go find something new, get the research funded, and then try to commercialize it. I guess I'm trying to probe for other ways of maybe thinking out of the box, for lack of a better word. Are there other sources of innovation that maybe don't require those tens of
millions? Well, we look at the effect of AI, right, on all of this, right? And I think there's a real potential, and we saw an announcement, relatively recently from the Trump administration. I'm trying to remember what they called it, but it was Project Mosaic or something like that, where they're going to really try to lean into how do we become much more efficient in our research by leveraging AI tools. So absolutely, that should happen, right? Like the amount of time, energy, and money that goes into biotechnical research that could be potentially circumvented by AI and AI modeling, I think is massive, right? So I certainly, if I was sitting at a large foundation and I was worried about whatever, drug discovery or something like that, like I would absolutely be leaning into brand new ideas around this. And I'm sure there'll be a lot of entrepreneurs that also come to the table and say, hey, how do we streamline some of these innovative processes so that we increase our chances of success and shorten the time it takes to do the research?
Got it. And
and I would just add one other practical idea, because I picked this up from a venture capital firm, Armory Square Ventures in upstate New York, who talked about if you're a startup founder, and most of those, right, are going to be located around a university where there's a core of people working on that particular problem. One of the partners at Armory Square said they advise their deep tech founders, or the ones in their network, to bring on advisors from big companies, because that's going to be a conduit for pulling down money from the company, or for partnerships or ways to test markets without necessarily getting constrained or having your innovative ideas killed by the environment of the big company.
Love it.
And by those big companies might also be good investors in that, right? It's not, I mean, we talked about, Microsoft and OpenAI. And by the way, OpenAI is captive to Microsoft, right? In fact, and Microsoft isn't captive to OpenAI. They've made some big announcements about working with Anthropic as well recently. So, but those are not bad avenues for some of this deep tech research to maybe get get funding.
Great. So which leads me to my last question on this topic, which is we've talked about a bunch of different actors. We've talked about a bunch of different sources. And there are others too, right? We haven't really talked much about corporate innovation. I mean, we have, I guess, talked about some corporate innovation groups, but we haven't talked about sovereign wealth funds. We haven't talked about private equity. We haven't talked about regional governments. Are there other maybe strong bets that you would care to make in terms of who would be right and suitable to step up to funding innovation?
Yeah, well, we've definitely referenced sovereign wealth because the references to UAE, Saudi, and Qatar are all essentially references to their sovereign wealth funds. So I think that the world is becoming more interconnected. And because of that, there are more players that think about and care about funding these innovative ecosystems, and they want them there, right? I mean, there's an entire section of Dubai that's a sort of a special tax zone that's designed to attract companies. PE firms tend not to be investors in the innovation economy. They tend to play kind of a different role in finance. I don't necessarily see that changing. They're just not set up to take the kind of risks that are required. But as Elizabeth already pointed out, there are family offices, individuals, others, maybe some communities, although I don't think sort of government venture style funds are particularly effective at investing in this sort of stuff. I think government grants to universities are effective ways of investing in deep tech. And again, that seems to have been sort of ebbing and not flowing at the moment. But I don't think that government like style venture funds are typically particularly helpful. But certainly there are government sort of public-private partnerships in particular. We point some of them out in the book that can be very effective for helping spur innovation ecosystems. We saw that around biotech and medtech in Pittsburgh. You see it around transportation technology and entrepreneurship more broadly in Detroit. So there are a bunch of examples where government partners with private sector to maybe spur an economy around a certain type of technology in a certain area.
Got it. So, and private equity, and I take your point, although I've been hearing lately that they have kind of stepped up closer to the back end of early stage investing in terms of rolling up some of these firms. So they're releasing some liquidity into the system, which then, you can argue can flow back into early stage venture. But your points are well taken. So there's all these little pockets of opportunity. They're very fragmented. You need to understand that Pittsburgh did the following things in terms of computer investments, 40 years ago, whatever the case might be, or, some of these other Detroit and all of these things. I'm a deep tech founder. I'm already in over my head. What counsel would you give to just max my chances to getting at these sources of capital?
I mean, send a lot of emails, really. It's what Seth said before, right? It's hundreds and hundreds of...
And use AI to get smart.
And use
AI to customize it, right? So look, there's no shortcuts to this stuff. And so I think it's everything we've already talked about. It's being open to moving to the right place where you're surrounded by the right people. It's seeking out advisors that will give you relationships both at universities, big companies, and potentially have relationships with funding sources, right? It is obviously working with customers as early as you possibly can to validate your ideas and product market fit. For the most part, really good ideas, generally speaking, get funded, right? And so that can be hard. And I understand that that's not easy, particularly if you come from a background where you don't necessarily have all those connections. There is no shortcut to figuring that out other than doing the hard work to reach out to people in a way that's meaningful and get them involved as, advisors, friends of, investors in your business.
And I'm hearing a theme also to add to what you just said. In all of this, I'm hearing a theme of accelerate your de-risking process.
Mm-hmm.
And make it more efficient was kind of like some subtext I picked up. I don't know if that was intended or not, but that is what I was hearing when you were...
And also, I would say accelerate, but also iterate, right? I think one of the things that sometimes happens at companies is you got an idea and your head's down on it for just too long. And you want to, the market is and customers are the best governor for you of whether you're on the right track or not and whether you need to modify. And that can't just be one customer because that's what they happen to want, right? You got to go out to a bunch of people and validate whether you're on the right track. And that will help you also raise money, get connected to potential advisors because there are people at customers or potential customers that can also be your advisor, right? All of this stuff kind of feeds together in a virtuous sort of circle.
Awesome. So one other thing that we talked about, you mentioned, like how geopolitical factors are coming into play, particularly when you talked about these advanced technologies getting funded. What are the lessons here for deep tech founders on two fronts? One is there's IP issues, especially on, some hard tech related domains where there might be other implications beyond just commercial. So there's that. And then there's also a question of where you source your key resources, the smart scientists that you need to hire, the labs that you may need to, to occupy. What are your thoughts are on that in terms of how capital is evolving for deep tech founders today?
I think that you're sort of getting into a deeper space in deep tech than my knowledge. So I don't know if Seth, you have any thoughts about that.
Well, I mean, we're also not particularly deep tech investors. And so what I've observed is that deep tech tends to work best when it's clustered, because then you can share resources. So that might look like finding other companies that have similar lab needs that you do, and then finding spaces that you can sort of work and collaborate together. That looks oftentimes like partnership and collaboration with research institutions who have already made the investment in that sort of, plant PP&E, property, plant, and equipment. And so those are the things that kind of come to mind. And that's definitely been our observation. I mean, we're trying to work on that in Colorado around quantum by becoming a quantum hub. And a lot of what we're pitching is there's value in the density of that, and there's value in the collaboration. And part of what we're trying to orchestrate here are some shared spaces, shared resources. So that's really easy when you're sort of just a blanket tech startup and you go to a co-working space. There's a bunch of other tech-like firms and you can get help and that sort of thing. And the same thing is starting to be more and more true for deep tech lab-based initiatives as well. But seek them out, because they are really good shortcuts, both to advisors and help, but also to shared resources. So you don't have to, you don't need to make your lab right from scratch. You can do it with someone else and not have to pay the whole thing.
So in other words, almost sounds like you're kind of building on what created the legacy in the first place, which was all this funding that happened over the last several decades. And now you're kind of innovating because you're building off of that and saying, what else can I bring to it to make it more potent, to continue to be as effective in terms of these corporate partnerships and advisories and all of these other things that you mentioned, and then continue to build on that critical mass so that you continue to attract the talent and then, build off of that energy to that virtuous cycle that you talked about. Last question on that. Policy volatility feels like constant now, right? Like every day is a new policy. How should founders, I mean, it'd be nice to think that it's all going to go away and we're going to go back to normal. I just don't know how realistic that is. So assuming you're planning for the worst always, how should founders think about uncertainty as they formulate product strategy, their capital plans, and how they're going to execute on that vision?
First of all, it's not that new, right? We feel like it's new. The turmoil feels very new and worse this year. But in fact, I remember when I was running a media startup 5 years ago, right? People were already talking about this in solar, the fact that the shifts in policy had really affected the fact that the U.S. and we lost the leadership edge to Germany and to China on solar because we kept having these wild swings in policy. So it's not new. It should be clear now to the U.S. government or to the people in power that it has a hugely detrimental effect not to have some continuity. Whether they're going to recognize that or not I don't know. But I would just say, again, it goes back to the I think what we're hearing so far is some themes, first of all, around geography, which are important. So there may be the swings in policy as state government becomes more important. The swings in policy may not be so marked at the state level. That's one thing. Secondly, I think you should be paying attention to the market and less the policy, because the market will almost always overcome, I think, any bad policies. Market forces are just too strong. I remember when we were growing Wealthfront, which was a company I was on the founding team of, and I live in Washington, D.C., so I was always very consumed by the idea of policy being so important. And Andy said to me one day, you ignore it, right? If you build something that really works and you find your market, it's going to grow so fast, policy will be catching up with you. So recognizing that the market is always stronger than the government, almost always. That said, there are a few venture funds that I know about now that specialize in helping companies that are in deep tech or very policy-driven spaces navigate that arena. So you can make that part of your pursuit of the right investor, right? Who can help you navigate the policy shifts? And if I can just add one story that I was thinking about when Seth was talking about always be iterating, because I think founders do tend to hold on to their vision for too long and just keep bumping their head against the wall. And when we were building Wealthfront, when the first product had come out of the gate and not been a huge success, right? It had some success features, some little things that would give you hope, but the conclusion was that it wasn't big enough, right? It wasn't going to give that hockey stick of growth. And everyone was kind of deflated and disappointed. And Andy, who was running the company at the time, reprinted the cover of a children's book, which you may be familiar with, which is Everybody Poops. I don't know if you read that to your kids. I read that to my kids when they were like 3 and 4 years old. And he reprinted it and it said, Everybody Pivots. Right. And it's just like recognizing that you do have to shift.
You have to pivot somehow. Policy just happens to be one big reason maybe that you do it now more than before.
Yeah.
I just want to talk about like one last topic, which you pay quite a bit of attention to, which is what does it mean to build a company now in terms of like ownership, trust, values, and credibility, especially in the age of AI, right? I mean, I can just whip up all kinds of blog posts that are seemingly in my voice in like 30 seconds. And yet credibility's never been more important. Right? How do you stand out in the sea of AI slop, as someone called it, right? So there's that on the one hand, and then there's just this overall erosion of trust in terms of who do you believe, who do you work with. So are there like high-level themes, guidance that you would offer to new founders or first-time founders in terms of A, understanding how critical these are to their success, and then B, some common sense, simple guidelines to navigate their path in this new world?
Starting a business is not any different now than it was before. I think we have this tendency to sort of be like, oh my God, AI, and there's all this stuff, and it's not any different. It's like, do you have an idea that you're passionate about? Is there a market for that, right? Can you develop a product that you can bring to market and get to market in a way that's cost effective? The tools to do that have changed a little bit, but the concepts are all the same. And I think there's a tendency to sort of think that all the rules have been rewritten, blah, 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 blah. And I just don't think that that's the case, right? The world still needs innovative ideas that have staying power, that are driven by people that have, real passion for those ideas and can take them to market. And I think we will probably see more, not fewer companies that arise because of this, because of some of the technological advantages, because lots of people have ideas, but lack the total capital to get those to market. And we now have the ability to get them to market faster and cheaper, which is great. By the way, that same thing happened 20 something years ago, right? When a bunch of internet technologies got modularized and all of a sudden, you had a much faster path to market than you had previously. And we saw lots more innovative companies, and there were huge companies that were built. So I think there will be massive businesses that are built that are started like today and tomorrow. And I think there's a tendency sometimes to just sort of feel like, oh, the game's changed and there's all this consolidation and there'll be no more, big startups anymore. I don't think that's true.
I don't think that's true either. But with
Good.
all due respect, you can say that the principles never change, but we're not living in a world of principles. Even principles don't pay my bills, right? Principles are good, but I have to live in the real world where it's the tactics and the actual mechanics of how a startup gets built. And I do think that what you said is right. I get it, right? I'm totally on board with that. But that said, how I implement it and how I win today is very different than how I would have won, 2 years ago. So,
which is very different than how you would have done it 10 years ago, right? I mean, at the end of the day, revenue paying customers are ultimately what creates successful businesses, right? And they are the sign that you have a product that people actually want and that you have that sort of elusive product market fit. And I think that what I'm saying is that the tactics for how you get there, how you're using different tools, et cetera, are potentially different. But in the same way that like how we communicated with each other 10 years ago was also different, right? We had sort of Skype and maybe a little bit of FaceTime that wasn't that great. And now we're on conference calls all day and we're not getting on a plane as much as we used to, right? And maybe sometimes to our detriment. because face-to-face still sometimes matters. But those are tools, right? Those are individual tactics. I'm going to have this meeting over Zoom versus I'm going to have it on a phone call, or I'm going to have it in person. If the goal of the meeting is to sell a customer, it's just the tactics that changed, right? Or if the goal of the meeting is to do product ideation, again, it's still the tactics that have changed. And I think that's the distinction I'm trying to point out. So it's great that we've gotten much more efficient in our tactics, and we've maybe opened up new avenues and new ideas for what those tactics can be comprised of. But at the end of the day, starting businesses is still about finding a product, or a market need, right? Building the product around that and figuring out how to get that in customers' hands where they'll exchange money for your product. And if you do that successfully, you will build a nice big company that's lasting.
Love it. Elizabeth, did you have anything to add to that?
Yeah, I would say, I mean, I like, I'm going to sound like a classic, it's like a mother, maybe, like, a peacemaker, I guess, because I see elements of truth in what both of you are saying. And obviously, Seth and I wrote the whole book together. So we're generally aligned on everything he's saying about the market, right? And the strategy and the fundamental truths are still true in America. But we are at this moment of transition, which we also wrote about in the book. And it is a deep transition, right? There's a lot that is stable, but you're not alone in feeling like everything is changing. And I would just say that the institutions that governed us for the past 70 years are weaker, right? They are clearly weaker. And in an environment where the institutions are weaker, everybody, including startup founders, has to be paying more attention to their relationships, because that's what gets stronger when institutions are declining. Your character actually matters more because people can't trust, right? Oh, you're coming from this big company. Well, that doesn't mean as much as it used to. Or you're coming from this university that's now under assault by the government, right? The institution is weaker. It doesn't mean as much in this world that we're evolving through at the moment. So I think you have to pay a lot of attention to keeping your word, to doing what you say you're going to do, to the people that you do form a coalition with, right? They do need to be aligned with your values. These are the things we write about in the book, because in this messy middle, those personal qualities do matter more.
I love it. I could live it. But yeah,
that's great.
It's very good advice, no matter even today or 20 years ago, right, Seth? We can agree on.
Yeah, exactly.
That's a fantastic segue. So if a deep tech or STEM founder, if you wanted them to internalize just one lesson from this book, Capital Evolution, to guide them to better success, more effectiveness, let's say, and be more effective over the next 5 years, what would that be?
Wow. I mean, I think it's a little bit of what Elizabeth was just talking about, which is like, and this will sound a little bit, or maybe a lot, sort of ethereal, but I actually believe it, which is like, expose yourself to lots of ideas, right? Like, I think the thing that's happened the most over the last, dozen years in our politics in particular, but just in general in our lives, is we've become increasingly insular in terms of the types of people that we meet with, the types of people we're friends with, the types of people we talk to, the media we consume, therefore the ideas that we're exposed to. And I think that actually is sort of the antithesis of what makes startup companies successful, which is being exposed to lots of different ideas and then picking the best idea amongst them. I feel really strongly about that. I think one of the real takeaways for me in writing the book and the whole process was being willing to be open to being challenged to some ideas. I think I changed my mind on a bunch of things. I think Elizabeth did as well in the process of writing the book. And at the end of it, I feel like I've got a much broader sort of overall perspective on a lot of different ideas. And I continue to seek information from different sources in a way that I didn't used to. And I think that's good advice for anyone listening just in their lives. But for startup founders, I think in particular, you have a tendency to surround yourself by people in the same industry, going after at least tangentially similar problems. And if not the same industry, a lot of other, startup founders, and you get this sort of tunnel vision. And I think it's helpful. That doesn't mean don't go work in the labs we talked about, or don't go work in the co-working facilities. But it does mean find some time to get out of that, right? And spend some time with other people that maybe have different perspectives or maybe aren't technologists at all.
Great. Elizabeth, what would your counsel be?
Yeah, mine is related to that, which is just to stand up, I would say. Like if you're a startup founder, recognize that we are in a moment of big transition in our society. Expose yourself to all those ideas, but recognize that you're not just soaking them in for your own interest. In this moment, you're going to build a bigger and better company if you know that it's aligned with what's good for your community.
Fabulous. And they say for every new thing you start, you have to stop doing something. So what's one thing that you would advise founders to stop doing that's no longer valid, as we evolve to a new phase of capitalism?
Oh, I would say, get off social media as much as you can.
I could use that.
Yeah.
Seth?
Yeah, I guess we could all use that. I like that, but I think I'm going to just repeat what I've already said, which is like, don't have this tunnel vision, right? Like, I think that and maybe that's the same comment as get off social media, because social media with their algorithms has a tendency to take us down this very kind of dark, but most importantly, narrow tunnel.
Awesome. So we've covered actually a humongous range of topics. I can't believe we covered so much in such a short time. Is there anything that you would have liked me to ask you, but I didn't?
Maybe the one thing is that, and it relates to this tunnel vision and social media and everything that we've been talking about. One of the themes Seth and I return to over and over is the importance of diversity. And I think some of the mistakes and some of the problems that we're seeing in the United States came from the fact that we were really governed by a small cadre of guys that kind of just, right, that were very hubristic at a certain point and just thought, oh, we're America. We're going to build this great society. Our form of capitalism is going to triumph, right? It's the best. And they got kind of rigid in those thinkings. And I think part of that was because they did not let other people into their circle.
Back to the idea of not having tunnel vision and, seeking actively different perspectives. Seth?
And they didn't consider that this very specific American form of both democracy and capitalism it never occurred to them that once people were exposed to that wouldn't be what everyone adopted.
Yeah.
And that's, China's the best example of this, right? I mean, they've become more closed, more insular, right? Since they joined the WTO and opened up. And I think it never occurred to anyone that would be the case. And I think to Elizabeth's point, that is a direct result of people with hubris and not getting sort of other opinions and other ideas into the mix. And I think that, part of why we tried to write the book was because we wanted to add our voices, not as the definitive voices, but just as here's another perspective, right? And it may or may not be right.
Yeah. Fabulous. I think that's a fantastic note for us to be more open, seek more ideas, disconfirm our hypotheses. So with that, I want to thank you both and congratulate you again on the book. All the best. I hope it rises quickly to the top of the bestseller charts.
Thank you.
And hopefully we'll see you back soon on another episode. Thanks so much.
Thanks.
Thanks, Shubha.
And that's a wrap for today. Thank you for tuning in. If you find these conversations helpful in your own journey, please subscribe to Seed to Success, our weekly community letter with tips, insights, resources, and more. If you have any other questions relating to startup finance or financial storytelling, send them over to me at chakras@achieve.co. That's chakras@achiiv.co. We'll see you on the next episode of Invisible Ink. Now, go achieve.